Hello and welcome to yet another instalment of our Nucleus Wealth Insights series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer and independent advisories. We also have David Llewellyn-Smith, co-author of The Great Crash of 2008 with Ross Garnaut, founder of the internationally acclaimed Diplomat magazine and now chief editor of the enormously popular Macro Business Financial blog. Finally, we have Nucleus Wealth's head of investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, please check out our people section at www.nucleuswealth.com.
Yes, so hello and welcome to our next instalment of Nucleus Insights, and today we've entitled it Good Defense is the Best Offense, and this is just in light of, I guess, some recent market volatility and also, I guess, general concern from investors, particularly about what we're doing in terms of lowering volatility and preventing or lowering deviation from the way that markets are operating, and also, I guess, the various asset classes that we employ to bring this in underway. So on that note, I'll just turn it down a little bit. So there we go. We'll run into an agenda. So today we're going to be looking at asset allocation, the various tactical mixes that we employ, and then rolling into stock selection and how, I guess, our actively managed strategies in terms of the stocks we select in the portfolio do also help to lower overall risk in the portfolio. And then, of course, finally, a look at the current outlook for going forward for the portfolios and markets around the world and how we invest every day at Nucleus Wealth. So with no further ado, I'll hand over to Damien and David. Welcome, guys.
Hi, Tim.
And we'll jump into asset allocation. Far away. Sorry. Yeah. So sure. Yeah, we've got a range there: cash, government bonds, corporate bonds, stocks, currency, gold, all the major pieces of a portfolio pie.
Yeah. So what we wanted to do is sort of run through the whole part about how do you protect your portfolios if the proverbial hits the fan and we start seeing significant falls, especially in stock markets, is how do you expect in a typical downturn these various assets to perform? A bit of a look at the correlation between different asset classes. So what we mean by that is typically what you'll find is that government bonds will decline when equities are rising, and vice versa. When equities fall, you'll get some increase in government bonds, but that doesn't always happen. So it's a sort of a correlation that you often see, but not always. And then sort of a bit of our thoughts on a bit of a this time is different. So if given the current situations we have, what are the issues that we could see, and where could we see things happening differently this time versus others? So we probably should start. So of the asset classes there, and then we'll jump into some stock selection side. So there's two sides to it. One is which assets do you decide to put in your portfolio, whether it be cash, government bonds, stocks, currencies, gold, all those types of things, or within when you've actually bought stocks, there is there's various sectors you can buy and overweight and underweight, and so and you see quite distinct performance in terms of those which stocks in which sectors are performing as well. So with that, we might jump into the cash side. So the first part for the cash, so this is obviously the safe asset. Not much. You don't get much in the way of a return globally on this. So in times gone past, and especially if we're looking at if you're looking at sort of 20, 30 year histories, it's important to remember that in sort of 20, 30 years ago, cash rates were much higher than what they were what they are at the moment, and so most international accounts you're either earning zero or very close to zero, and even in Aussie accounts 2 or 3% sort of the typical sort of return you're going to get. So in terms of upside, there's not much upside. In terms of downside, look, your main downside is whether you're and the main question we get from people is whether you see banks fail and people sort of lose money from major upsets from that. Our take is very much that there's a government guarantee which sort of covers you for part of that money, but the big issue is will government step in and bail out depositors if a major bank was to fail? And our take is pretty much it's going to happen. So David, I don't know if you...
I think that's right. The political consequences of not doing so are immense. So I think it's a fair bet. That said, there is legislation in place that enables some bail-in of depositors, but I think the likely trajectory of any bailout would leave the resources available to not need to go that path anyway, because our public debt is low enough that we could kind of take the hit. Yep. I mean, it would be a generational shock to the budget and a kind of permanent step up in the deficit, but I think it unlikely even so that those kind of extreme measures would be necessary, and they've only transpired in very few countries.
Yeah, and most of the countries where we've seen any of that form, they've actually been like Ireland, for example, actually helped all the debt holders, so not just the depositors, but the debt holders actually got most of the money back as well. So the depositors, you guys are the depositors sort of first in line. So I guess what we're saying from there is, look, it's possible, but seems to us very, very unlikely that there's a significant amount of downside in terms of this time. And so sort of we'll leave that one to the side for the moment and maybe jump onto some government bonds.
Sure.
So government bonds now, as a difference to corporate bonds. So corporate bonds, you are generally exposed to two elements. One is the actual interest rate cycle, and the other element is the whether the companies you've invested in are actually going to survive, and whether they're going to have a default event or whatever that ends up, you end up losing capital on those. So in terms of government bonds, that you generally don't have the issue of there being a default and particularly for domestic ones. So if you're talking about, saying, an Australian investor investing in Greek bonds or Portuguese bonds, then you do have an issue if you're investing overseas. But in terms of investing in your own government bonds, it's very, very rare that governments ever default for pretty much the same reason as what we spoke about for the cash side. What you can get is you can get inflated away by inflation, which basically means the governments print money to give it back. So there are issues. You do need to worry about default risk if you're investing in overseas bonds, but if we're talking about domestic bonds, your real risk isn't a default of the Australian government. It's that they can't afford to pay and they need to print a whole bunch of money in order to pay back depositors. And again, that's another risk which certainly in recent times has been very low. There's a dance both the US central banks doing, the European central banks and Japanese central banks, where they're lending the government money and then putting it back and shifting it around in terms of this monetary printing, which isn't quite monetary printing, which basically means that if you've got your central bank buying effectively an unlimited amount of your bonds, it's very hard to default on that.
Yeah, and they almost invariably fail on generating the inflation anyway.
Yes, absolutely.
Because most of these strategies are counterproductive in terms of generating inflation. They tend to support bad businesses and bad debt create kind of a zombie supply in the economy that weighs on inflation endlessly, and then you add all of our other structural overhangs in inequality and demographics, high debt, etc. And even when they've printed, they've really struggled to inflate anything away.
Yeah. So what that comes back to for government bonds is saying government bonds are a pretty good asset for when something bad happens, as long as there's nothing a central issue with the economy you're in terms of that actual government having problems. Then usually the government bonds will actually rise in value. The interest rates will fall because people are expecting interest rates will need to be lower, and those will rise in value. Especially if we're talking about Australian bonds, which is where our sort of key focus is on these government bonds.
I was going to say, just on that note, from our Nucleus Wealth and macro business fund portfolios, where pretty much this is us as in regards to bonds, like.
We're not heavily overweight. Oh, sorry, within our bonds.
Within our as an asset class.
Absolutely. There's two types of, and the other thing is there's two types. But we actually let's jump into some correlations quickly. David, I might
hand over to David.
Sure. Well, this one's just to illustrate the point that the capital value of bonds tends to rise when the capital value of equities falls.
Sure.
And so if you want to look through this chart, you'll just find whenever the ASX falls that interest rates fall on the 10-year, which means that the capital value of that bond is rising.
Sure.
And so at least throughout that entire period, it's been a very reliable safe haven if you're looking for protection from equity risk or volatility. That said, as Damo just mentioned, there are occasions where particular economies have more intense and structural adjustments, and that correlation can break down. So you're kind of seeing that at the moment in some emerging markets where bonds are falling in capital value terms just as stocks fall as well. But that's largely a function of capital outflow.
Sure.
And so, there is a tail risk of something like that in Australia. It's a very long tail scenario, but one in which perhaps if there were a major China shock, and that were enough to sort of sink housing, perhaps really pressure the banks' balance sheets and trigger a bailout and shunt a lot of that private sector debt onto the public balance sheet. Possibly in that scenario, you might see pressure on government bond prices at the same time as you saw equity prices, but it's quite an extreme scenario. You would probably also need to see much higher offshore funding rates for the banks and a whole lot of things going wrong. Basically, it's the scenario in which you have an Australian financial crisis. It's not impossible, but it is a long tail risk.
And I guess from our perspective, that's more likely in 5 or 10 years' time. I guess if you sort of saw, is it because government debt's quite low, we've still got a chance to transfer a lot of private debt onto the public balance sheet first, is the first step.
Yep.
And then after that, the next step is then, okay, well, another next crisis comes along, now you've got no more firepower left, and that's sort of where...
Yeah. I mean, the other part of that is the sovereign rating, of course. If you start to lose or be downgraded at the sovereign level repeatedly. In Australia's case, that is very difficult because it cascades. The federal budget guarantees state budgets and banking offshore debt as well, and so you get this cascade effect where a federal downgrade can roll through interest rates throughout the whole complex. And so, to get into that tail risk scenario, you would need to see a sequence of sovereign downgrades, and for that to transpire, you really would need to see very serious damage to commodity income flows, and so it really comes back to China too.
Yeah, right. Okay.
So we want to jump to the next.
Yeah, jump to the next one.
Got a next slide up, which is just sort of showing a very long term. This is a US government bonds versus stocks correlation, just to sort of show that the correlations are low. So basically, what that's showing, if correlations is if you're perfectly correlated, one goes up, the other one goes up, and correlation of 1, and perfectly negatively correlated gives you one goes down, the other one goes down, the other one goes up.
Goes up, yep.
And so they're not generally. They are generally very low, very lowly correlated. So the one we're showing here, you're just sort of maxing out at sort of about 0.25 in terms of correlation on the positive side, and about negative 0.5 on the negative side. So and they have been negatively correlated for the last sort of 10 or so years.
Sure.
We do expect that to continue for some time. We think a lot of that positive correlation was the falling bond rates, and bond rates pretty much globally are close to the bottom. There's not a lot more room for them to go down. So, but it is worth noting that correlation doesn't always hold. It's just will it hold this time? For the Australian economy, we think that on the balance of probabilities, yes, you will get the holding, but if things change, you need to consider again. The other types of assets within government bonds you can get is what's called inflation-linked bonds. So we generally try and choose between whether we're buying non-inflation-linked bonds or inflation-linked bonds.
Yep, sure. So inflation-linked bonds being...
So an inflation-linked bond... So government... Let me start with the government bond. So government bond issued at $100, say, and it'll have a yield attached to it, and that yield might be, on some of the bonds we've got, it's still relatively high, it might be sort of 5%, for example, which means that bond, so it issues on day one, 10 years ago at a 5% yield, and
pays
with $100 face value, and so it's paying out that money. As the yields fall, as government bond yields fall, the price goes up, so that you're effectively getting, so now you might be getting a 3% yield on that instrument.
Yep.
Which means you're buying at $110, $115. So but in the end, you still get your $100 back, and you get your $5 every time.
Sure.
Inflation-linked bonds are different in that the amount you get back actually rises every year, depending upon inflation, and the interest rate's paid on that higher amount.
Okay.
So basically, rather than being $5 for that entire period, now you're getting $5 plus whatever inflation has come through, and so what that means is the yields are generally much, much lower. And so you'll buy inflation-linked bonds when you're concerned that inflation is going to spike, and when you're not concerned too much about inflation is when you'll be in the normal bonds.
The fixed rate ones. Okay.
And so at the moment we're pretty much in the fixed rate ones. We've got some inflation-linked bonds for a bit of a hedge, but generally speaking we're in the government fixed-term government bonds with a view that inflation is now a problem.
Okay. All right. Very good. Thanks for that. So just continuing on with the corporate bonds. So. Yep. Upside and downside. I guess you've sort of covered off on this at the start there. You've got the equity risks essentially built into a defensive asset, which isn't always great.
Yeah, that's right. So the issue with corporate bonds when markets turn is that usually what you find is that the risk of default goes up quite dramatically and there'll be a subset of companies where this is very, very true of, but other companies that don't have high default risks tend to go up in sympathy. And so what you find is that whereas government bonds, quite often you get a negative correlation, in corporate bonds that's not always the case, and sometimes you actually get quite a positive correlation. And during the financial crisis we saw that in a bunch of things that people would consider to be people thought were quite safe assets and sat in this fixed income part of their portfolio, particularly the hybrids that are listed on the ASX. There were a lot of those hybrids where the proverbial hit the fan. Government bonds went up in value, so if you're holding those, great. If you're holding all these corporate bonds, but you actually lost a lot of money, not as much as you would have lost in the stock market, but you still lost a lot of money. And so the issue you have for those is saying, well, if the joke is for some of those you've got all the upside of debt, which is none, and all the downside of equity, which is lots. You just want to make sure you're not sort of caught in those parts where you're buying assets. You need to know what you're buying in terms of those assets. And there are ones, particularly hybrids, are a great example of ones which institutional investors tend not to own. So very, very few. It's basically a product for retail investors who like to think, yes, I've got this, I've got a Commonwealth Bank bond, I'm as safe as houses, that'll be fine. Whereas the institutional guys are going, what, you're paying, you're only paying that yield? If I was going to buy that asset, I want another 2 or 3% above just to justify it. Whereas a retail investor gets away on the brand of this and it's sold through their stockbroker or whatever it is. And so, so I guess the issue for corporate bonds...
The banks wouldn't do that, would they?
No, of course not. But the issue is, corporate bonds, you've got to be really careful about what you're buying and and because it's
Because there's correlation, essentially.
yeah,
Sure.
so not the same as a government bond.
Okay, sure thing. All right, so that's the defensive side. We'll roll into the
Stocks, yes. Stocks we'll leave just a really quick one because we're going to go into a bit more detail on that. But stocks generally, when the proverbial hits the fan, stocks get smashed. That's
Yep.
you know, of all the asset classes, they're the ones that are going to fall the most.
Yep.
But we'll come back to that in a little bit more detail later.
Okay, sure. So then, I guess currency, and is this currency as an asset class per se, or is this sort of just an overlay on the other assets themselves and how they're priced and what they're priced in?
Yeah, that's right. So I guess the big issue is working out that currencies can move quite dramatically, and generally what you find is that there's a bunch of safe haven currencies, so to speak, which the US and Japan very much fall into that category, and the euro to a lesser extent, but it sort of depends upon where the crisis is happening as well. So when a crisis is centered in the US, obviously it's not as much as a safe haven. Once that crisis happens in the US, it generally filters to the rest of the economy. Once that happens, so you might often see the US fall initially, and then the crisis ends up in every other country, and back goes the US, goes back up again, and to where the money comes back to.
Okay.
It's not just that they're safe havens, it's also they're funding currencies. So it means they're lending out a lot of money for carry trades, for yield trades or equity trades into emerging markets. Like, when the cycle's booming, everyone's chasing returns, then they tend to borrow in these low interest rate environments like Japan and the US, and then take the money elsewhere. But when the proverbial happens, you got to
pay it back in the same.
They all repatriate really quickly.
Yep.
And that exaggerates the safe haven nature of those currencies.
So what's different this time? And it's important to remember the Australian economy, the Australian currency, sometimes gets mentioned as a safe haven. It's actually a little bit. There's probably a very small. It's probably a slight safe haven in any initial stages, but as soon as things get bad, we're not too far away from emerging currencies in terms of the issues, as we're primarily an exporter of commodities.
Yep.
And when world growth is going well, commodities go up a lot. When world growth reverses, commodities go down a lot. And that's
the dollar reflects that.
Yeah, it's a dollar reflects that.
Most of that has just been rhetorical rubbish. Well, we are just a risk currency, really.
Okay.
When the globe is global growth is going well and risk appetite's there and animal spirits are, in control and what have you, then the Aussie rises, and when it's the reverse, it's the reverse.
The big thing to note in terms of this time is different for the currency is that we are now a much larger exporter of gas than we ever were before, and that's going to keep growing over the next few years. So if you compared it to a 1990s sort of recession type thing, the big difference between then and now is that now back then we were, I don't know if we were even we may well have been an importer of a lot of this stuff. Now we're a major exporter of gas and only going to get bigger. We'll be the world's largest, if not, it's pretty soon it's coming up. I think we're about to overtake Qatar. So what matters now very much is what that gas price does, and most of that gas is benchmarked to the oil price.
Yep.
And so if anything, the key difference that could happen this time is if the oil price is high at that point, that'll cushion the fall. We'll probably still see a fall, but that'll cushion a bit. If you see the oil price falling as well at the same time, you're going to get an exaggerated effect because both other commodities, both the industrial commodities and the oil price fall at the same time. Then an exaggerated effect on there.
Okay.
I mean, this is a troubling question to my mind, because a lot of those LNG exports, not all of them, the West Coast stuff is better, but the East Coast gas exports are all basically profitless. And definitely taxless.
Yes.
And so even though they raise the terms of trade, which typically correlates with currency, up or down, the material benefits in the real economy simply aren't there. So
they were there when we built it.
Yes, maybe then, but not anymore. And so you could have a kind of perverse scenario in which that component prevents the currency from falling quite as low as it would normally, But by doing so, it's not actually doing it with any benefit to the economy, and so it's therefore actually retarding, all the other exporters that would have benefited from that fall, which implies then that you're not going to get the currency relief that you were, and it may have to keep falling anyway.
Yeah.
So fair point.
So it's a complex one. That one. We are now a net oil exporter, oil and gas, for the first time ever.
Okay.
And it will remain that way. It'll get a bit bigger, but we do import a lot of oil, so it's not by a large margin.
Okay, all right. And just, I guess, going back practically to the portfolios, the currency obviously is a fairly big determinant in the way that we position what we do.
Yeah, absolutely. There's one of the real asset allocation benefits of sitting inside Australia and investing, looking out, is that the currency acts as a buffer. So to put that back the other way is if you're an international investor investing in Australia, it's actually a very high beta economy, you'd call it. So what I mean by that is if you stick money in Australia, if you're a US investor investing in Australia and growth's going great and the stock markets are booming, you get an uplift from stock markets booming and growth going well, plus you get an uplift from the currency going up. The flip side is, so you get like a double return. The flip side is when it turns, you get a double negative on that. What's good as an Australian investor looking out is that reverses. So when things are going well, the currency is rising, and if you're investing offshore, so you're losing out on your currency and gaining on a world growing.
Yep.
But the flip side happens when when the proverbial hits the fan, currency drops, which actually cushions the blow of international markets falling. And so that's why we like it as an asset right now. It's not always a good asset, but right now over the last few years and over the next year, 2 years, we think it's a great asset for most people to hold, because you can get this this gradual grind higher as markets rise, and in the last 12 months we've probably done almost 20% in terms of the international fund.
Sure.
So you've sort of kept hold of that growth. But on the flip side, if things turn, you've got that buffer sitting in there that'll help cushion the blow. And we saw that in February, where US markets fell by 10% ish, and our holdings in our fund sort of were more like 3 or 4% down over that same time period because of the diversification and the benefits of the currency at the point.
Okay, yep, look, great example there. Fantastic. Moving on to gold. I know there's plenty of gold bugs out there, so this could be a point of contention perhaps, but let's try and keep it platonic.
Well, yeah, I mean, gold is obviously sort of top of the pyramid for safe haven plays emotionally, but the fact is it's actually very cyclical itself, and so in a structural sense, it is the premium safe haven, if you like, if you're concerned about really system level risk.
Yep.
So if you're talking some kind of fatal blow to fiat currency in general, maybe a world war, something that really jeopardizes the value and reliability of the institutions that make up financial markets, then gold is obviously structurally valuable.
Sure. Okay.
Having said that, though, you need to work out the depth of the crisis you're expecting, because if it's
I mean, this chart, is that one up?
There it is. Yep.
Yep. Relation between the direction of the US dollar index and the direction of gold. It is the primary driver of the gold price, is the value of the US dollar. So if you're going to think about gold across a cycle as a safe haven, you have to think about what's going to happen to the US dollar, whether or not gold is an appropriate safe haven for you. If the end of the cycle that's transpiring is going to lift the US dollar, then gold is not going to work for you as a safe haven. That said, if you're doing it from Australia, you will have the benefit of the falling Australian dollar. So gold in Australian dollars would be better, but even so, you're still going to be buying a deflating asset just when you think it's going to appreciate.
Yep.
It's going to go the other way. And we saw a classic case of that. If you look through the GFC period, I think gold fell from $1,000+ to about $650 during the GFC, and everyone was shaking their heads.
Yep.
And what the hell? And it was because the US dollar was repatriating like mad and going up like topsy.
Mm.
And that happens just about every crisis. If you look on the chart, it's happened through the last 3 end of cycle shocks, so it's pretty reliable. There really aren't many end of cycle shocks. Well, I haven't seen one in my lifetime where the US dollar doesn't get a bid, and so gold is actually quite problematic when you get into cyclical accidents.
Yep. So it's useful to think of gold as partly a commodity. As partly a currency.
Yes,
Yeah.
quite right.
Yep.
The odd part about this is that the time to buy gold, therefore, is actually during the crisis.
Yep.
Not buying it before as a safe haven, but picking it up during the crisis itself. Because what transpires during and after a crisis, of course, is the cutting of interest rates by the Federal Reserve,
Yep.
which, as soon as things stabilise, trashes the US dollar, and suddenly gold is in very high demand.
Sure. Of course, that would mitigate you or predicate you actually holding large enough reserves to buy the gold during a crisis, which is normally
Yes.
when everyone's reaching for capital rather than sitting on it.
That's right, and even if you're planning on trading gold in that way, you're not using it as a safe haven. I mean, you are just simply trading a commodity
It's
asset.
an asset class.
Yeah. So, I mean, there's one other point I guess I would make about that chart. The huge run-up that we've seen, you can see, has been much larger than the fall in the US dollar. And so I just make the point that, some would say that sort of goes against my argument, but it doesn't. They're not proportional one-to-one. Basically, it's about the underpinning stability of the US dollar and as the reserve currency. And when those underpinnings are shaky, then gold will go up. And so it's about the trend. As long as that shakiness is there, then the alternative, the UNDollar, the alternative US dollar, gold will rise. And so there is an equivalence in the value change, but it's in a trend term, it's very, very closely correlated. So, for instance, that big run up, was through a period where the Federal Reserve, is fighting deflation for many years. Had twin deficits in the US. There's a lot of uncertainty with new, money printing and new monetary tools, a US, housing crisis, of course, and all of those things that and then geopolitical questions about the rise of China, all sorts of stuff, which really challenged the foundations of the US dollar as the reserve currency, and gold just loved that, right? But as the US has kind of turned around, it's been through its structural adjustment. It did a lot of deleveraging for households, and obviously had its gas and oil boom, and has simply come out of the quagmire better than others. Then gold's really been struggling ever since because the stability has returned to the US dollar.
Okay. Yeah, fair point. Damien, just a quick one. Obviously no gold in the portfolio at the moment. Thoughts on it going forward? Are we ever going to see gold in an MB fund or?
No. Look, the whole idea of the Nucleus Fund is that we've got core assets within this fund, and so we've got large cap Aussie equities, we've got government bonds, not corporate bonds, we've got large cap shares and cash. And so the idea is that we're sort of trying to hold the assets to sort of sit within the central part of somebody's portfolio that you pretty much want to own all the time, and you want to use that to get your diversification and control the risk in your portfolio.
The nucleus
of your portfolio, exactly, the core or nucleus. And then the idea is then around that you can then, if there's times to buy gold, there's times to buy private equity or emerging markets or small cap equities. There's the right times to buy those ones. But we're trying to do that central part and let people sort of drift in and out of those other assets as they see fit. And for many people, they never bother, and they're just happy to keep that central, that central return, and that you can sleep at night, and you don't have to worry about will gold double or triple or halve or quarter type thing over a time period or.
Okay. Yeah. Look, fair enough. Okay.
Just finally on gold and the question of this time it's different. Just a couple of scenarios where. We think through whether gold could go up at the end of this cycle. given the array of risks that we face. Is there anything there that could trigger a gold rally? If we get the normal run-of-the-mill meltdown coming out of Federal Reserve tightening, absolutely not. You know, that would be US dollar bullish.
Yep.
You'd see a classic stock market shakeout, and you would expect gold to take a thumping during that crisis, as you know, money repatriates into the US dollar. Trade wars, there's nothing really there either. I mean, some are arguing that this is going to accelerate the decline of the US dollar and the rise of the yuan. I don't buy that at all. I think that's largely rhetorical. I can't see how the yuan can really threaten the US dollar even long term. It's just an opaque market, incredibly opaque markets in China. Capital controls, runs big trade surpluses, so there's no debt to buy. Very difficult to see how the yuan can rise. It can certainly sort of populate a few alliances, trade alliances and stuff, but that's really marginal. And to sort of make the point, when you look at the IMF reserve currency holdings for sovereigns, the yuan is considerably smaller than the Australian dollar. Let alone the US. It's like 2% or something of US dollar holdings worldwide. Yeah, it's rising, but it's
low base.
Well, it's extraordinarily low base, and I just think, China has set up a sort of alternative set of financial market, structures like the IMF and World Bank that are more suited to itself in the yuan. But again, they don't have the alliance network for that to populate very widely. So that scenario doesn't make a whole lot of sense to us. We don't really see that playing out. The only one that I can see where gold might benefit, and I suspect it would be in a race with the US dollar anyway. I think they would both go up. Is one in which Italy was to really threaten the euro.
Oh, right.
So if we either that being a trigger for a shock, or during a shock that was to add to it, or the adjustment was politically chaotic enough that it forced more change into Italy, then if the existence of the euro were threatened, I think that's a sufficiently severe blow to large-scale fiat currency in general for gold to benefit.
Yep. Okay.
But that said, I think the US dollar would go to the moon in that scenario. So it doesn't seem to be a lot of point to hold gold anyway, if you can use the US dollar as a hedge.
Sure. Okay. Yeah, no, that's a good point. All right, we better press on. So we'll roll just quickly through some alternative assets. We've got a couple there: commodities, real estate, private equity. You sort of touched on these before as potentially external holdings to what we do at Nucleus Wealth, but they bear a quick... a few quick thoughts.
Commodities generally, when world growth is high, commodities go up. When world growth is low, they generally go down. Now, it's not true across every commodity and not true across every cycle, but in general terms, good demand, commodities go up. And so you usually see commodities fall quite precipitously in these events. Real estate very much depends upon that. Real estate's an interesting asset in that if the crisis is centered around real estate, then they're obviously going down.
Yep.
But it does have it is a bit of a safe haven, and so if it's not centered around real estate, then you can see some benefits in it.
Lower interest rates, obviously, in any crisis is obviously it makes it a potential safe haven.
That's right. Yeah. The thing to note though as well, and
if it's not massively overinflated already.
Yes, exactly. Which for Australia, we're on the path of saying, well, Australian real estate, we've got our concerns that a crisis could well be centred on Australian real estate. So a holding of real estate, it probably isn't going to be that useful. The other thing to note with all these alternative asset classes, quite often during crises, you see sort of things about how well some of these assets have held up relative to equities. That isn't always the case, even though they look like they might have. A lot of these have rules about how often they need to be revalued. And so quite often it may well be that stocks are revalued every day. Is that the asset's been revalued last year at that cyclical high. It needs to be valued once every 3 years, at least once every 3 years, and the asset manager's just going, well, if I don't revalue that asset for another 2 years, that gives me a chance to jump over the chasm that's opened up, and hopefully in 2 years' time the price, the real price has fallen 30%, but we'll have recovered 20 of that, and so I'll just be able to say, well, over 3 years I lost 10%, and look how stable my asset was, which is not the truth of what's happened below that. So I guess for all these, it's more for me about saying, well, what asset are you actually buying? And something, let's say private equity, you've got equity in an unheld firm. Generally speaking, the value of those firms is very, very correlated to the stock market. It's just not listed every day. And so it's the same thing. Some of these guys will only revalue when they do a capital raising. And if they've done their last capital raising, they'll tell you about look how well look what great correlations, negative correlation to the stock market and all that. Well, the only reason why that happened was because you didn't revalue any of your assets for a year.
Yeah, sure.
During the crisis. So some of them are interesting. We haven't got enough time to go into which ones are and which ones aren't. There are certainly some alternative assets that can provide diversification, but there is plenty of them that either provide worse or are
very correlated.
Yeah, very correlated, but they just don't mark to market, so they look like they're way better than they really are. And I guess that you've got liquidity issues there with a lot of those. Yeah, absolutely. Liquidity is a key one. Is that and actually I'll move. That's probably a good into the stock selection because one of the interesting things on the stock selection side is there are a lot. Usually what you find is the best stocks out there and the highest quality stocks are often the most liquid as well. And in the early stages of the crisis, there's hedge funds and traders who are just basically, I need to get out of stocks. I'm already in liquid stocks. I just need to dump whatever I've got. And even people who are sitting looking at going, well, I've got 2 stocks to sell. One really high quality, one that's traded heaps, and one really low quality where there's this massive bid-ask spread, or maybe there's no bid at all on this lower quality one. Right. I'd like to keep the high quality one, but I have to sell for debt reasons or for whatever it is to bring down my thing. So I'm selling the most liquid asset.
Sure.
So quite often you see some of the good quality stuff get hit a little bit harder at the start, which is often a great opportunity for equity managers to go, right, now's the time to pick up the stocks I've always wanted to buy but never could. And then the next phase of the crisis is as all the low quality stuff and the illiquid stuff gradually gets sold from people's portfolios, and you get that rebalance.
And you get that, and they're obviously potentially bigger hits on those portfolios as well, because they're just going to have to take any price.
Yeah, that's right. and at that stage, that people go from risk on to risk off, and it's the part about hey, look, this company doesn't make any money, but it's going to think about how much money it's going to make in 3 years' time, to just a minute, this company doesn't make any money, and it might not be here in 3 years' time, so why would I want to own it at all? And so it's just that the thought process that people go through, from positive to negative, and so so you want the good value and the cheaper ones, but there's basically 3 types of let's jump to the types of stocks that we look at. There's a few different classifications sort of we go through. One by economic type. So generally, I like to look at it as there's this class of stocks that are interest rate sensitive or bond proxies, and that includes real estate, utilities, telcos to a certain extent, a lot of infrastructure stocks. So the idea is these ones have got very, very stable cash flows, and they're almost like a bond in terms of, like a corporate bond in terms of the way they're going to trade. Yes, you might see some downside, but nothing like the downside you'll see in other stocks. So when the proverbial hits the fan, these are the stocks that are going to hold up. As long, again, with the that proviso that as long as the crisis isn't actually centered on them. Then you get the sort of the next step up. You get the defensive stocks, and these are the ones which are the more like your consumer staples. So the stuff you buy every day. It's your food, it's your toothpaste, it's your shampoo. It's these stocks that, regardless of whether there's a financial crisis on or not,
you've got to clean your teeth.
You've got to clean your teeth, and that's right. Keep going through. So there's those ones. Then you get to what we call the cyclical stocks, and they're the ones that are more related to growth in the economy. So resources sort of sit in this category. You also see things like consumer discretionary. So if you want to buy a Louis Vuitton handbag, it's much easier when economies are booming and all that type of stuff. There's lots of people out there with lots of money to buy these handbags. When everything hits the fan, all of a sudden there's a lot fewer people that decide that, yes, I'd like to spend a couple of grand on a new handbag.
Sure.
So generally speaking, they're the ones that get hit the most. So you sort of go, the interest rate sensitive ones are pretty good. The defensive ones, you often hold up pretty well also. The cyclicals are the ones where you really get hit. And then financials, again, is a little bit of that. Depends upon, they've got elements of a few of these, and it depends on where it's centered. But they're more often than not, financials will get hit in the when the crisis happens.
Okay.
So that's one way to look at it. The next way is sort of by this quant factor, I call it. And so this is the part that comes back to, we've done a few different podcasts on these, but the idea is, are you a quality stock? So are you better than most of your competitors, earn higher margins? Are you the one in the industry that when the people turn to for safety, or are you a very low margin player who's just surviving on the edge? So that's sort of, and as you'd expect, quality stocks tend to outperform when crises happen.
Sure.
Value stocks, so what we mean by value is things that are cheap versus things that are expensive. And again, the cheaper stocks are the ones that tend to perform better. So and in a way, a value strategy is basically, I buy cheap stocks all the time, and you generally underperform the market by a little bit, and then a crisis happens and you outperform massively. And so so it doesn't happen every time, and we spoke a lot of that was about the definition of value, but largely that's your take on a you want to be buying high quality stocks that are cheap.
Yeah, that makes sense.
Growth stocks are sort of your other quant factor. They're the ones you don't want to be holding. So the stocks that are priced for what they're going to do next year and the year after, and all that type of stuff, with no look at what's currently happening. And they're the stocks, when the economy grows 5%, they're going to be growing 10%. But when the economy shrinks by 5%, they're shrinking by -10 or -15. And so they're the ones to avoid in these situations. There's some other factors, sort of momentum, which is another pretty similar to growth. What goes up the most generally is what falls the most. So so you can look at those, and that's another factor we tend to look at in terms of how we're positioning our portfolio. So on the first set, we haven't actually got that many interest rate sensitive, just because interest rate sensitive are very, very expensive at the moment.
Sure.
So we're piled into the defensive.
Okay.
And then we've got a few at the other end. We've sort of got a bit of a barbell in our portfolio. We've got a bunch of defensive stocks, and then a few on the cyclical side to take advantage of this last phase of the US growth. But keeping that sort of that base of stocks there that if things happen, you'll then sell those stocks at higher prices and go and look and try to see what you can buy in some of the growth stocks.
And I guess this strategy is, obviously as an active manager with the portfolios reviewed daily, this is, it's imperative that it needs to be happening that way if you're going to play in that space.
That's right. Yeah, your sort of bread and butter is just trawling through and which stocks are up and down and where they sit on various quality metrics and value metrics.
Sure.
Small caps, large caps, you usually see when things go well. In times of trouble, large caps generally hold up better than small capitalization stocks. And if you're talking about micro capitalization, like when I say small capitalization, I guess I think of large capitalization as sort of equivalent to the ASX 50, maybe a little bit bigger. Small cap sort of sits somewhere between that and the ASX 300, so still talking $100 million plus stocks.
Yep.
When you talk micro cap stocks, which are the really small ones, they're the ones that can really get smashed, just because there's just no buyers for your stock, and so often you just got to wait it out or whatever it is, just because there's not you're missing a bit at that point in time.
Sure.
Geographically, you can play around with a little bit of this as well. Again, that comes back to where is the crisis, affects most of the geographies, but you do find US, Japan, again, will hold up a little bit better. And Japan sort of depends upon what you've got, whether you've got exporters or not, but geographically you'll see differences. And then by business type, what I mean by that is whether you're a manufacturer versus a service company versus and how long your cycle is. So what we spend a bit of time, is looking and making sure, well, if you're a business that's invested a lot of capital up front and a crisis hits, it's bad luck. You're going to sit there and lose money for a few years, hoping everything turns around.
Yep.
Whereas if you're quite an asset light business, well, you might be able to cut your costs quite quickly and get back to cash flow positive a lot faster than somebody else who can't. So
Gotcha.
The type of business you've got matters as well in terms of that.
No, that makes sense. Okay, sure thing. Plenty to think about there.
Yeah.
Okay.
Quick chart on correlations. This is just a long-term one, just sort of showing that between countries, there used to be quite low correlation between countries, but globally, and this is over sort of 100 years or so, but that's changed. Like now the correlation is pretty high, and especially in large caps, because these companies are seen in so many different countries already. The correlation can be very high, and it's more about knowing, what stocks do I own in my portfolio, and then which countries are those stocks in, because versus knowing that, yes, I own a McDonald's or a Starbucks that's actually in a whole bunch of different countries. Yeah, it might be more focused on the US, but it does actually have a pretty global reach.
And is there, is it the overall just increase in the ability for capital to move around the world helping that correlation as well?
Yeah, absolutely. It's obviously much easier now to buy a stock in the US than what it was 20 years ago, and certainly vastly different to what it was 50 years ago.
Sure. Okay. Yeah. All right. Very good. And still on the topic of correlations.
Yep. Yeah. So I've got a correlation matrix up there, which I'll let people look through, in their own time. But I guess the point of this was just to highlight that some assets are very correlated to each other traditionally. Now, the other thing is correlations change, and they're not always the same. And every single time, it needs to be, what is this crisis, and will the general correlations hold?
Sure.
But you can see the green on this chart shows you which assets aren't very correlated with each other, and the red shows which assets are very correlated, with the idea that, well, if you've bought some US large caps and you bought some US small caps, well, you haven't got much diversification. Whereas if you've bought one and you've bought some bonds on the other side, or you're stretching into emerging markets or whatever it is, you can get some pretty different correlations with them. The correlations are, can be good or can be bad with that. Yeah. There's some stuff in there by sector. I've got another one which is sort of another correlation chart, which is which sort of shows very similar types of things, but for across some of the more major asset classes rather than the individual sectors. And so I'll probably leave that at. Yeah.
Yep. Okay. Nope. Sure. If anybody would like copies of these, just let us know at webinar@nucleuswealth.com, and we can send you through the slide pack as well. So, just wrapping up now. I guess obviously implications for investment. We've gone fairly broad and then quite detailed in a number of the areas that we look at. It's been fantastic. I guess just broadly speaking, though, looking forward, I guess as well, more than anything. And the way that we're positioning our portfolios, given the assets the asset allocation we've looked at today.
Yeah. So what our take is that we're in the final stages of this whole growth boom, US centric sort of growth boom, and that'll absent some sort of crisis in the meantime, that'll keep filtering out to other countries and keep demand in some of these other countries ticking along. We've got some issues in terms of China and how fast China slows, but generally speaking, it's about saying, well, how can we make sure we're not sitting out this final stage, because it could be a drawn out. We could last a year, 2 years, 3 years. It could be a long drawn out process of topping, and making sure that you've got some exposure to that. But on the flip side is making sure you've got downside protection. So if everything unravels quickly because of something Trump does, or something happens in economies, or China miscalculating its fine job of slowing the economy without crashing it, that you've got protection within your portfolio. So that's sort of where we're sitting at the moment. We don't think it's time to be really, really conservative, but sure, we are quite conservative at the moment. And that was that whole thing with what I call the barbell risk in stock selection is, a bunch of quite safe stocks. Having said that, we're steering away from the real interest rate sensitive, just because we can't find stocks we think are cheap enough, and we've sort of got a whole mix of the stocks, whether it be Kellogg's and Kimberly-Clark's and Unilevers and these sort of stocks that provide quite safe quite high quality and steady earnings. We've sort of gone for a whole basket of those to give us sort of that diversification.
Okay.
And at the other end, still trying to hang on to some of the growth through whether it be recruiters or things like that in the US that are benefiting from the employment boom there.
Okay, fantastic.
We've got a bias towards US growth, but we're pretty wary of overpaying. And what that means is we're quite often picking up stocks that are a lot cheaper, sitting in some of the peripheral markets that actually do have big exposures to the US. So whether it be Norway, Denmark, UK even, where we can find some stocks that are listed in other countries but actually have pretty decent exposure to the US, and so we can buy it at a much cheaper multiple than if you actually bought a similar stock on the US stock market.
Yep, and just quickly as well, obviously there's a bit of turmoil in Europe, so what are you doing anything there? We're looking, is it building a shopping list, as it were?
Yeah, absolutely. So we're underweight to things within the Eurozone itself.
Sure.
But we've got a bit of a shopping list there, particularly Italy. We've been going through Italy. We don't own any major holdings there, any direct holdings, but we've got a bit of a shopping list. If something does happen there, we've sort of got our list of these are the stocks we'd like to buy, and if they fall to these prices, then we're in.
Okay.
And so they generally tend to be exporters or things like that. But there's certainly. I think it's important to be looking forward to these things and knowing what you want first, and at what price you're happy to jump into these, rather than waiting for the crises to happen and then turning around something going, oh, just a minute, we've got to do all this research and work out, do we like these or don't like these?
Yep.
Most of the time it's the Boy Scout, be prepared and where are you expecting things to go wrong, and okay, if things do go wrong, at what stage am I saying, well, this is low enough, because otherwise you can sort of be stuck, frozen and deer in the headlights type thing.
Yep.
Crisis is happening, what do I do? Let me just do nothing and hopefully it'll all avert. But if you've got the plan sort of set up beforehand, generally tends to work out better for you.
Okay, sure thing. Any notes there, David?
I guess I'd just add that there is something idiosyncratic about chasing the US at the moment, if you're Australian, because the particular macro setup where you have a booming US and a slowing China and emerging markets potentially gives you the combination of rising US equities and a falling Australian dollar, which obviously sets up potentially very good returns. And as Damo says, that's why we're definitely late cycle, and you never know how late you are, and so we're quite conservatively positioned. But that setup and opportunity is what keeps us in the market at the same time.
Sure. Okay, very good. And we just had, and I noticed there, as our final point for Trump risks there, we've had obviously we're shooting this live, we've got a question there on the World Trade War is on. What comes next? History shows that a real war might follow. Is there any thoughts on that one, just to finish off in terms of perhaps macroeconomically, but also perhaps from the portfolio?
Yeah, well, I mean,
I'll say that if the trade war remains warm without going super hot, then it plays into what we've just been talking about.
Sure.
It lifts US inflation, probably lifts US growth short term, and lifts the US dollar, and it does damage to China and emerging markets. So we're positioned for that.
Sure.
If it were to really intensify, it's a big leap even if it intensifies to get to war. There's all sorts of variables at play here, but at the moment you can see, despite Trump, really attacking everybody, including his allies, on a number of different fronts.
He's given the Germans a spray this morning.
Yes, he has. And I think people are kind of adapting to it now. They realise that they're in for a spray, and so they don't overreact, even if it's very much outside of protocol. But underneath that, you've seen some really interesting shifts around the world towards Chinese trade. Europe, China effectively invited Europe to join it in resisting US tariffs.
Okay.
And it rebuffed China, because Germany obviously is based on IP. It's a high-tech economy, and the Chinese technology transfer structures just don't work for Germany. They don't work for Japan. They don't work for the US.
Sure.
They're not fair. Then at the same time, you've got China, building this One Belt, One Road extravaganza, which is an enormous infrastructure undertaking. But there are half a dozen examples now of those projects being canned, cancelled, embroiled in controversy, delayed, pushed back upon, largely because of corruption. And so, there is a bit of building momentum against China, which is going to give the US, greater momentum in taking on China. So how far do they push it? Well, we're not quite sure. We think China should do a deal. We don't quite understand why it doesn't do the sort of deal where it could just buy a whole lot of US oil and gas, take the heat off. It helps Trump for 6 months or a year, but for China it helps it for 10.
Sure.
And we think that would be the sensible path for China to take. Perhaps it's been delaying on that while it sort of it takes the temperature of global reaction to Trump, and maybe they were looking to see if they could rally the world against the US and do its alliance network a lot of harm. That hasn't worked. Doesn't seem to be working. So at this point, the US has kind of got China where it wants it. And I guess if you boil all that down, I'd be surprised if this does not end in some form of backroom China capitulation.
Yeah, right. Okay.
Once enough pain has sort of transpired.
Yep.
I guess the other component to it is domestic US politics. China might calculate that it can pressure Trump, via targeted tariffs, counter tariffs, various other mechanisms that will lose him votes. And then you've got the midterms in the US. If the Republicans took a caning on that front, they'd get very nervous about trade, and maybe they can gamble that they can use domestic politics against Trump and see him off in that way. But it still actually makes more sense in terms of Chinese national interest, which should be the driver, for them to do some kind of deal before this gets too out of hand. The problem for them is if they really push this, the Chinese push back, Trump's in a position, and the US is in the position to do them a lot of harm. Very big tariffs, the Fed's hiking, you could get into a cycle of US inflation, capital outflow across emerging markets and China, and a potential financial crisis even for China. Like if the yuan really starts to crash, they run out of forex reserves trying to support it, it would be a really big gambit for them to take the US on in a geopolitical sense. A foolish one, in my view. And it's possible if they provide that opportunity to Washington, it will take it. So I don't think they should push that hard either. To me, it's very clear that the national interest of China is to do a deal. And interests usually determine the outcomes, but when, is in the lap of the gods. Okay,
and just as it was a bit of a follow-on question, but I guess I think it probably runs along the same line. Where it says here, looking at the islands built by China and the tension between the surrounding countries, is it possible to use war to get out of in case of a downfall in the economy? So essentially, can we stimulate through destruction? Essentially,
well, you certainly can, and if you're struggling economically, then finding an external enemy is sort of dictator 101. But I mean, China has a lot of other tools. Like China would have to be in a pretty extreme circumstance to be thinking like that.
Sure.
And you probably see a few proxy wars before you see a real war.
Yeah,
and so we haven't got to that stage yet.
Yeah, and the thing is, there's no military equivalence between China and the US. We're talking one broken aircraft carrier versus 22 or 23.
Yep.
I mean, there are many different variables in this. China has an army of subs, and there's a whole lot of other factors. But just in raw military power, they can't compete. So I'm not sure they would would want to try.
Yeah, okay.
The other sort of strategic component of this is North Korea. Like the Chinese. It's very much in the Chinese national interest to get the Marines out of South Korea. Mm-hmm. The deal that Trump's offered them is a terrific one for China.
Sure.
Through Kim Il-jung or him, and so he can. China can. Trump can dangle that deal as well, and China can risk that deal. If it pushes this too far. So, there are a lot of different chess pieces on the board from which China could benefit by dealing with the US, and not that many by resisting it, frankly.
Yeah, sure.
But I guess as an overarching theme is, I guess what we're saying is, for a lukewarm trade war / more tension, that's where we're positioned. If it gets super hot, we'll be changing asset allocation at that point in time.
Yeah.
It's pretty much a given. And the other one to note is the other big one is the oil price. And the other risk from a Trump perspective is just whether he does do something in Iran that's much bigger than a few more trade sanctions, or whether you do end up in a war or a proxy war in Iran or whatever the case is. So that's obviously a big risk across a number of ranges. So we probably it's one we need to look at. If that gets more serious, we'll need to look at some of our holdings for that type of event.
Okay, well, good to know. All right, fantastic, gents. And so if you'd like to know more information about how you can get the power of everything we've spoken about today in your portfolio, here's some information about Nucleus Wealth.
Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment. To ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com.
And so that wraps up today's Nucleus Insights. I hope you enjoyed it. I certainly did. It was a feature-length episode this time round, but certainly plenty to think about in the way that we manage risk and help protect client portfolios on a daily basis. If you like that one, you'll love next week's one. So same bat time, same bat channel. We're actually getting the Nucleus Wealth Chief Economist in, Leith Van Onselen, as well, to cover off on what is now Australian housing boom over. So as you've probably seen in the press recently, there has been a marked capitulation in house prices, as been predicted in the macro business side for many years now. It's finally here, so we're going to pop the champagne and run through some figures on exactly where it's happening first up and what to look forward to going forward. So if you'd like to check that one out, head over to proton.nucleuswealth.com to register your interest, and we can keep you up to date with any updates as well. So We're also, as always, we're available on iTunes and wherever your quality and reputable podcasts are available. On Android, Podcast Addict is one that it is available. Just check us out. You can either type in Nucleus Insights or Nucleus Wealth in the search bar and get access to the various podcasts we've put out over the last 6 months or so. So thanks very much for attending. As always, we will be sending out the survey where you can give us a bit of feedback on how we've gone today, and also feel free to drop in any topics you'd like us to research and bring to you in the coming weeks. So on that note, thanks very much for attending, and we'll look forward to catching you at the next one. Cheers.